Banks pay you 2% and lend your money at 10%. That spread is the start of how banks make money. Let's walk through the basics. First, banks collect deposits from customers. Think savings accounts, checking accounts, and term deposits. Those are liabilities for the bank. Second, banks lend money to other customers and businesses. Loans include mortgages, personal loans, and business credit lines. The difference between interest paid to depositors and interest charged to borrowers is called the interest spread. That spread drives profit. Banks also earn fees and other income streams, which add to profitability. We'll cover the main fee types shortly. Finally, banks operate under regulatory rules, including reserve requirements. We'll explain fractional reserve banking with a simple diagram. Deposits are what customers give the bank for safekeeping. Banks record them as liabilities because they owe that money back. Loans are assets for the bank. When a bank lends, it expects interest payments and principal repayment over time. Each loan has a rate based on risk, term, and market conditions. Higher risk usually means higher interest for the borrower. Banks match deposits and loans through asset liability management. They balance liquidity, profitability, and risk across the portfolio. Not all deposits are the same. Some are easily withdrawn, others are locked in for a term. That mix affects how banks lend. Understanding deposits versus loans helps explain why banks care about customer stability and long-term relationships. The interest spread is the core profit engine. If a bank pays 2% on deposits and charges 10% on loans, that 8% gap matters. Multiply that spread across millions of dollars in loans and deposits, and small percentages turn into significant earnings. Net interest income is the total interest earned on assets minus interest paid on liabilities. It's a primary revenue line for banks. Market rates and central bank policy shift spreads over time. When rates rise, banks can adjust loan pricing faster than some deposit rates. Competition and regulation can compress spreads. Banks must manage costs and risk to preserve profitability when spreads tighten. In short, the interest spread is simple math applied at scale. It's the most transparent way banks convert deposits into profit. Fees add meaningful revenue beyond interest. Common examples include account fees, overdraft charges, and ATM fees. Banks also earn from interchange fees when customers use cards and from service fees on wealth management and advisory products. Investment and trading desks generate non-interest income through market activities, asset management, and underwriting fees. Fees help diversify revenue. During periods when interest margins are thin, fee income can stabilize overall profits. Regulators and consumer expectations influence which fees banks can charge. Transparency and competition have tightened fee practices. Taken together, fees plus net interest income form the two main pillars of traditional bank revenue models. Fractional reserve banking means banks keep only a fraction of deposits as reserves and lend out the rest to earn interest. For example, if the reserve requirement is 10%, a bank holds $10 for every 100 deposited and can lend 90. Those loans then become deposits in other banks, which can lend again. This process multiplies the money supply in the economy. Regulators set reserve rules and capital standards to control risk and ensure banks remain solvent and liquid under stress. That combination of interest spread, fees, and fractional reserve mechanics explains how banks generate income and support lending. Takeaway: banks make money by earning a spread on interest, charging fees, and using fractional reserves to multiply lending and returns.